Okay, hello everybody. Welcome to Asset Management at Wharton Online. This is Adam Ring, the Program Director, and I'm joined by your professor and my colleague, Jules van Binsbergen. Hey, Jules.
Hi, how are you?
I'm doing great, Thanks, everyone, for joining us today. It's exciting to be here for the first week. Jules and I have been working on the program for some time now. And we hope you like it. I think the first week's been going really well, and this is our first live session. And so what I wanted to do is first just give a little bit of a background about kind of what this session is, and then overall how to think about the program. I think, as all of you can tell, you've been able to look at some of the videos from course one. You've been able to look at the quizzes. You've been able to look at the forum. Those are all key components of the learning program. And then this live session is really designed for you. So Professor van Binsbergen is giving us time for office hours. So anything you want to ask Jules that's on topic, that's what we're here for. It's really to be an extra resource for you. If there's anything from the videos that you want clarified, if there's any current events related to the weekly topics, this is what it's there for. It's a really great interactive resource for you, and we'll hope that you will use it to your advantage. One question we had is in terms of the quizzes and when they're due. We recommend everyone do the quizzes each week, just because that's when we're going to be reviewing the material. But they're not going to be actually due until the end of this course, which will be in 3 weeks. And from a graded perspective, while you can get a 10% bump if on one of your quizzes you score 17 or higher, the key components for the grade are going to be the case study, which Jules has selected, and then the final exam at the end. So we'll talk to you more about that. But in general, some people say, well, what if I can't get the quiz done on Sunday? Don't worry about it. If you can get it done each week, it's great. But we know people are busy. Just try to follow along as much as possible so you don't have to cram it. But we know people are busy, so try to keep it as flexible as possible. So that's just, again, just to get that out of the way. We want to, for this session is really for you. We're going to be doing Q&A today. I've gotten some questions that people have emailed me, and I've got some questions as well. So if you, what I would suggest is if you use the chat box below, that I see folks are writing. And if you're having any issues hearing, I think just turn up your speakers. Just submit those questions there, and then we'll get them answered. So with that out of the way, Jules, maybe just as a general question, I know people are always kind of curious, how does someone become a professor at Wharton? So I'm curious, maybe you could just give us a little bit of your background, how you found your way to Philadelphia.
Sure. So let me tell you a little bit about my life story and then how I ended up eventually here. So I grew up in the Netherlands and also did my undergraduate studies there in financial econometrics. And after that, I decided to first go and work in the private sector. And so I spent some time at various banks. One of them was Goldman Sachs in London. And then after that, I decided I really wanted to do a PhD. And so doing a PhD is the way to become a professor. I did my PhD in finance at Duke University. And after graduating there with my degree, I went on the academic market. So that means that you apply for academic jobs and you try to become an assistant professor. Being an assistant professor implies that you get a 6 to 7 year period to prove yourself on the research side, which is what we call the tenure track. And at the end of that, people decide whether you can stay or whether you need to look for another job. And so I did my tenure track at Stanford, got tenure there, but then also I had a joint placement thing with my wife who had job opportunities actually at Goldman Sachs on the East Coast. And because I really liked Wharton's finance department, I moved to Wharton in 2014 and became a professor there. So that's my life story in 35 seconds.
Oh, that's great. Well, it's always interesting. I know everyone takes a little bit of a different path, so that's great. That's great perspective. Thanks, Jules.
You're welcome.
So let's kick it off with some direct questions. Again, I've got a full list. We'll start with a few questions that Dan just emailed me this morning. And then I've got a full list, but I'm sure you guys have your own questions. So please don't be shy. Anything you want to ask, again, just please use the chat box below. So Jules, the first question from Dan relates to what are differences, the different challenges faced by pensions funds, institutional funds, sovereign wealth funds, et cetera, and how does that impact the managers that they select and or the products they select?
Okay, so I think the first thing is to determine what the objective is of the various institutional investors that we're talking about. And one thing that makes pension funds very different from a lot of the other institutional investors is that defined benefit pension plans, as they are called, they've actually made promises to pension holders. So because these pension holders, they have been contributing to the plan through premiums, and therefore that has made the asset base of the pension plan grow. But in exchange for those premiums that were paid, generally a fixed amount of money is promised in the future, say 70% of your salary, even inflation indexed. And therefore, as a pension plan, you cannot just say, hey, this is the amount of money that we'll have and we'll just have to do it with that amount of money. No, it's all measured relative to, hey, we made promises that over the next 30, 40, 50 years, we would pay this amount of pension money to each of these beneficiaries. And what is now going to happen if we don't have enough money for that? This is what we call a pension plan being underfunded. And in the video, I think we briefly talked about that right now, a lot of these plans are underfunded. And so then, of course, the question is, well, how are we going to respond to that? If we're underfunded, how should we fix that? And I think one of the questions that I got emailed had a similar question in it, like, hey, how can you resolve that if that underfunded situation is so bad? It is really bad, in the sense that if we take the defined benefit plans for private and public and we add up the shortages together, we're talking about several $1 trillion that these pension funds are short. So how can we solve it? Well, one is, which unfortunately we see quite a few funds do, is take more risk and hope that, by gambling, and you can get yourself out of the situation by getting high returns and recovering the underfunded status that you had. The second one is, well, you can try to increase the premiums that the pension holders are paying, but of course there are limits to that. For public pension plans, what you can try to do is increase taxes, but then of course people will start to move out of the state if those taxes become too high. So that inhibits you there. For the corporate plans, what you will have to do is ask the corporate sponsor, so the company that sponsors the pension plan, to chip in and try to recover the underfunded status. So you can see there that pension plans are quite unique in the sense that they have these promises, also called liabilities, and therefore a lot of their whole investment management philosophy is very driven by what those promises are. This is very different from a mutual fund. What does a mutual fund try to do? Well, a mutual fund an active mutual fund wants to beat a benchmark, wants to just get the highest possible returns. You don't have to worry about the promises that you've made. You want to get the highest possible return given a certain level of risk. If you outperform, people will give you more money. If you underperform, people will give you less money. So the main thing that a mutual fund wants to do is just try to outperform the index and that they're trying to beat. I think that hedge funds are in that sense very similar to, say, mutual funds, because they may use some somewhat different strategies, like they may take more risk. But the objective is in many ways the same as it is for mutual funds. Mm-hmm. Now, sovereign wealth funds invest on behalf of sovereigns, and so again, they're more like, in philosophy, like the mutual funds than they are like the pension plans.
Great. And just to follow up on that, Jules, you reference an aspect of the video where you talk about the pensions being underfunded. How serious a problem is this? Do you feel like it's being talked about enough? What are some scenarios that you're looking at as going forward relative to that?
Well, so the opinions vary a little, but I think none of them are particularly optimistic. So first of all, given the fact that we have such a large amount of underfunding, so take a state like Illinois. They have made a lot of pension promises to their teachers and other public employees. We know that the fund is heavily underfunded, and they're so underfunded that something will have to happen. Now, the thing is that, of course, and that I hadn't mentioned that one yet, one other solution to this underfundedness problem is just to say to the people that you promised the pensions to and say, hey, you know what? We promised it, but we're just not going to deliver on it, and we're just going to cut the pensions. That's another way of doing it. And of course, ironically, people in the public sector, often we would say, hey, the salaries may not be that high, but at least you have a wonderful pension. Well, that last part may now actually be under pressure. If those pensions, the promises are not being kept, then of course the pension may not be that wonderful. But in many states, actually, it's not possible to cut the pensions, because you would need a change to the constitution of the state to even be able to change the level of the pension benefits. So that's just not a solution. And so given the amount of money that they're short, increasing taxes, you would have to increase taxes by so much that would lead to a problem, because if the tax rate becomes too high, people will just start moving across the border so that you just get lower tax rates from the neighboring state. So that doesn't really, that has its limits in terms of getting that achieved. And so I think quite a few people are worried that these states may actually get into financial trouble quite soon, like we've seen with some cities. States may actually get into trouble too. And then, of course, the question is, will the central government step in to back them up, yes or no? So I think that to answer your question, the problem is very severe. The amount of money that is involved is very large. It is not at all obvious how to fix it, and because the problem has become so large. Of course, again, what I think some people are just hoping for is that now, if you take quite some risk and those risky bets pay off, then hopefully at least part of the problem will sort of go away by itself. But we also understand that if you take risk, then things may work out really well, but they may also work out really poorly, meaning that you're already underfunded, and because you're gambling so much, you may end up with even a further underfunded position going forward. Mm-hmm. So we'll see where it's going. It's very serious. It's a big problem, and I'm not quite sure. I think there are many people that see the urgency of it. The question is whether the people that are in charge and that need to make decisions on it are seeing the urgency of it.
And so would you say, obviously consensus on something like this is a moving target, Jules, but would you say you're kind of more concerned than you think consensus is relative to this topic, or in line?
I think academics are at this point more concerned than I think others are, even though I think that many governments, local governments, are inviting these academics to come and do the computations for them, so that it becomes clearer and clearer how big the problem really is. Mm-hmm. So I think it's penetrating. Yeah, interesting. Okay, thanks, Jules. We had a follow-up on that from Janet. Janet's curious about, with respect to defined benefits, if it's underfunded and the individual is approaching retirement, at what point does the individual find out that they're not going to get what they thought was coming? Yeah. So here is what's going on right now, which is this. You have a certain amount of promises that you've made. That has a certain value. You have a certain amount of assets that you have today that has a certain value. What you hope is that the value of your investments is worth at least as much as the promises. Now, if you're underfunded, that means that the value of the promises is bigger than the value of the assets that you have. But it's like, you already know that you have not enough money in your bank account to cover all the mortgage payments that you need to make over the next 30 years. Let's assume you don't have a job, you have no other source of income. You just have a bank account from which you make your mortgage payments. And you gradually see this balance on your account go down and down and down, and you know that you're going to run out of money before the mortgage term is up. But of course, for as long as you don't actually hit zero, you could actually keep on pretending that every single time you can keep on making your payments. Even though if you've done the computations, you know that the mortgage is 30 years, and you know that after year 16, we're going to run out of money. Now, of course, as we get closer and closer to year 16, the urgency becomes bigger and bigger. But as a pension holder, you may actually not find out that you're not going to get the money that you were promised until the actual money runs out. That doesn't mean we cannot see it coming, that it is going to happen. The urgency only really becomes there, as we say it, when it becomes a cash flow problem and not so much just a balance sheet problem, meaning if we compare the whole amount of mortgage payments that we need to make relative to how much money we have and we know we're short, that's a balance sheet problem. That's not an immediate problem in terms of how much money we need to pay today. And so right now we're still in the state where it's more of a balance sheet problem than a cash flow problem. But you can also see that once it really becomes a cash flow problem, then we really have a very big problem. And then a lot of people will start to object to this. So hopefully we will start to make up the balance that we have so that we have enough money in the account to pay the remaining mortgage payments. And we wouldn't be in much better shape if already today we would be in a comfortable situation that we have enough money to make the remaining mortgage payments.
Great.
So I think that's the answer.
Thanks, Jules. Got another one from Dan. Question is, how do, in the videos you mentioned one of the hedge fund strategies as multi-asset strategy, also known as multi-strat. What are their key risks and benefits, and are they likely to continue growing at the rate that we've seen over the past decade?
So I think that the rate at which mutual funds and hedge funds grow is very much related to the outperformance that they can deliver. And so if hedge funds or mutual funds start to structurally underperform, which we've seen many funds do, then what you see is that they gradually start to shrink. So now the question is, if you would start your own hedge fund, or if you are a hedge fund, is, well, what strategy will I pick that I think will lead to the best outperformance? And now the thing is that picking that strategy actually depends a lot on how many other people would also pick to do that strategy. Because obviously, if we're all doing the same strategy, then already prices in the market will adjust to reflect that, and it's going to be really hard to make money off of that. And so therefore, I think that some hedge funds want to create more uncertainty sort of about what the specific strategy is that they're doing, so that it's not so obvious that they're part of one particular group of what strategy they're in. And whether or not going forward there will be a lot of outperformance, yes or no, given how crowded the market is. And we've seen growth in these industries over the last decades that is very large. And indeed, I think right now the question is just, are these industries too large? Are they about the right size, or can they still accommodate some more growth? Right? And and I think the opinions on this vary. I think that particularly for the mutual fund sector, people probably have come to the conclusion that it is about the right size, if not a little bit too big, meaning that active management, it's getting harder and harder for active management to keep on outperforming. So one way to solve that problem is to come up with new strategies. So one thing that we've seen, for example, happen is that a lot of hedge fund and mutual fund investing before was very domestically oriented. But as the domestic market got more and more crowded and more players were operating in this domestic market, people started looking for international investment opportunities and finding international stock markets where the competition and the crowdedness wasn't so large, and therefore giving them opportunities to explore investment opportunities there.
Mm-hmm. So is your sense then that to some extent multi-strat can be more marketing than anything else in terms of communicating investors, and it's really just gives them the flexibility to pick whichever the strategy du jour?
In the end, I think that in general there is a lot of marketing involved in terms of convincing investors to dedicate their money to particular funds, right? And in many ways that's also the job of the fund. You need to convince investors to come and give their money to you so that you can invest it for them. And also, let's be clear, I mean, a lot of the rents and the revenues that these funds make is simply a function of the amount of money that they have under management. For mutual funds, the revenue of the mutual fund company and the manager is simply a fixed percentage from how large the fund is. So if you can charge a 1% fee and that 1% fee doesn't change, how can I increase my salary? Well, by making sure that I get 1% of a bigger amount, which is to have more AUM. If I can convince people to give more money to my fund by marketing the right strategy, and I know that that will work, then obviously that is what the fund will do to get that money in. I saw in one of the group chats, somebody asked a question and said, what is it exactly to be a beta neutral strategy, right? And so you see that some hedge funds say this. So let me try to explain this. So we know that as you take more risk, you can get higher returns. Now, one measure of the amount of risk that you take is called the beta. And soon we are going to take a look at where that beta comes from. It comes from a model that is called the capital asset pricing model. And so we'll have some videos that will get us there and where that model exactly comes from. But you can think of beta as the amount of aggregate stock market risk that you're taking. So if the aggregate stock market goes up, then if your strategy goes up by the same amount, say by 10%, then we say that that strategy has a beta of 1. If when the aggregate stock market, say the S&P 500 or some other big index, goes up by 10%, then your strategy, if that happened, goes up by 20%. So meaning, in general, your strategy goes up by double the amount than what the aggregate stock market does. You've loaded up on stock market risk with a factor 2, and we say that that is a beta of 2. So what does it mean to have a beta neutral strategy? Well, you can set up a strategy so that the stocks that you invest in are not sensitive to aggregate stock market movements, and therefore they're just sensitive to the movements of those stocks themselves, not how the whole group behaves. That's what we call beta neutral. So think of it this way. If I have one stock that goes up by the same amount as the market, and then there's some other noise around that, but on average it tends to go up by the same as the market, and I have another stock that does the same thing. It has also its own sort of noise around that, but on average it tends to do the same thing. If I take a long short position in those two and I invest in one by shorting the other, I exactly cancel out the common movement between those two stocks, and therefore I have no more exposure to the aggregate stock market. That's what we call beta neutral.
Great. Thanks, Jules. Mario just had, just a follow-up on that, which is, so what is the sense of a beta neutral strategy versus just an ETF?
Well, in ETF, it doesn't have to be made beta neutral at all, right? So an ETF is what's an exchange traded fund, is just a way of investing in a basket of stocks together, but you have an ETF that is the S&P 500 ETF. That ETF will go exactly up by as much as the market does, because by definition, it's designed to do that. It's designed to replicate the S&P 500. So that will just by definition have a beta of 1, because every time the S&P goes up by 10%, because that's what we're replicating, that strategy will go up by 10%. I have exactly that multiplier of 1 on it. And so it's not at all beta neutral. It has a beta of 1. So beta neutral and ETF are two orthogonal concepts. Great.
Follow-up it relates to, Jules, could you comment on the role of robo-advisors in the industry? Any thoughts on that subsection? Maybe just explain it to folks who are new as well.
Well, so the question is, we're seeing in general in society, we're seeing this trend towards this idea of, what sort of decisions can we let tech make for us, so that we no longer need intermediaries that need to help us with these decisions. And if a lot of things can be automatized and can therefore be taken over by technology, and we can cut out the middleman, if you will. Of course, there's still people that need to set up that automation process, and they still end up being to some extent the middleman. But because it's all automated, you can take out a large part of that management process, and therefore hopefully offer things at lower costs. Right? And so the question then is well, some managers have expertise, and that expertise means that they need to be able to respond to market conditions as they evolve over time. To what extent can a robo-advisor, so an automated process, do as well? as a person that is keeping track of things for you can do. And what are the differences in costs? And is it true that man versus machine eventually is going to mean that machine is going to win? Or does it mean that man is going to win? Of course, the question always with man versus machine is who is programming the machine, and that's still man. And so we'll see how, how that process will evolve and what the rents are in that process. But certainly it's an exciting development. I think that generally speaking, competition is a good thing because competition generally leaves consumers better off because it lowers fees and it lowers rents to particular people. And so if robo-advising can in fact deliver, then that would be nice because that would just lead to better things for consumers.
Great. Thanks, Jules. Question from David, going back to hedge funds. David's curious about, and this is a topic we'll discuss in specifically in week 4 of this first course, but he's curious about regulation of hedge funds. How sufficient is the auditing process, and sort of what's your level of trust in that process?
Yeah. So I can give you 2 answers. One as an academic and one as an investor, right? So one of the reasons why we have so much research and we know so much about mutual funds is that they're audited very carefully. They have reporting requirements. They have to report their holdings. They have to report their returns. They have to do a lot of things. And because of that, we can make sure that the data that we get from these data providers is very accurate. Now, that's very different for hedge funds. So if we want to see, for example, how on average the hedge fund industry is done, have they done well or have they done poorly? How have they done for the investors and so forth? Then, of course, the question is, what data are we going to use for this? And if the data is self-reported by the funds themselves, you can already wonder, some funds might decide not to report, others might decide to report. Who do you think is more likely to report the returns? The funds that have done very well or the funds that have not done so well? And so therefore, I think overall the data quality for hedge funds is much poorer, which leaves investors in more uncertainty about if you would now put your money into a hedge fund, what should I expect to get from that process, right? And so I think that the other side of the argument is as follows. We like financial intermediaries to operate in financial markets because they help price discovery, meaning we want asset prices to have the right price because asset prices have a very important signaling function in the economy to what activities are profitable and what activities are not profitable. Now, you can imagine that if you do your research and you spend a lot of time investigating things and therefore you find out that prices need to be different and you trade on that it's only worth it to do all that research if you're also allowed to take the rents that come from that process. Now, if I have a regulator that is essentially asking me the whole time to report and therefore to give away my strategies and to give away the information that I very much used to collect, it cost me a lot of money to collect that data. That's going to interfere with that process. Suddenly it doesn't become that interesting anymore to be able to invest so much money in it if essentially I'm asked to give away the information immediately anyway. So it's a thin line between these 2 things where you say, hey, we want to have very good reporting and we want investors to know what they're up to. But on the other hand, we also want these financial intermediaries to do their job in terms of setting prices correctly in financial markets without forcing them to give up their information that they spend a lot of money on collecting before they had a chance to earn back. Otherwise, we'll just see that those parties will disappear from the market and they will not help to set those prices to the right level. And I think that the current form of regulation that we have is that we've said, listen, there are mutual funds which are really more for retail investors that we feel we really need to protect. And therefore, we have a lot of regulation there. And we make sure that there's full transparency about everything that's going on there. But we also see the value of the other side of the argument. That's why we have hedge funds. Hedge funds are much less regulated, so they have more room to do that price discovery process, which is also important. But because we can't protect the consumers as well in that segment of the market, we're simply going to have requirements for people before they're allowed to invest in that segment of the market. They need to be what's called qualified investors. They need to be more sophisticated. They need to be people that need less consumer protection than the retail investors that we see in the mutual fund market.
That's a great explanation. And what's your sense, though? I mean, in terms of balancing those considerations, do you feel like we're at a reasonable point, or we're leaning, kind of one way too far, or where do you come out on it?
My sense is this: there's huge uncertainty about where we need to be, but I certainly think that where we are now is in the reasonable range of the uncertainty that we have. So it's certainly not the case that it's obvious that we need to move in one direction versus another direction. We're somewhat in the right ballpark. Now, given the amount of uncertainty that we have about where the right amount is, which is, by the way, I think is always true with regulation, that is also why in the political process, there is so much room for political debate on how much regulation anywhere we need to have, because there's just too much uncertainty about what amount of regulation is optimal. If we had more research and could try to find out where that optimal point is better and reduce that uncertainty, then we could give a more exact answer to it. But the conclusion is right now, it's certainly not the case that we should say, hey, hedge funds definitely need to be more regulated or less regulated, or mutual funds need to be much less regulated. I don't think the discussion is that obvious at this point.
Great. Thanks, Jules. A follow-up on pensions from Janet. Janet's saying she's heard that there's something called warranty management that is offered for pensions funds. Is this relatively new, and are you familiar with that at all?
I'm not familiar with it. Can she tell me a little bit what it is?
Yeah, Janet, maybe just write in if you have any more color. It's a new concept for me too. I'm sure it exists, but if you could just give us some more context, it would be helpful. A question from Roger on shorting. I think you provide some explanation, but people always for people new to the market, it's always a little bit tricky. So maybe just kind of explain it again.
It is very tricky. So let me just explain to you how it works. Okay. So suppose that there is a stock, General Electric, and suppose that you currently think that that stock is undervalued, meaning that the price is too low from where it needs to be. How do I bet on that? Well, it's relatively easy. I just go, I buy the stock because I think it's a bargain, it's a low price. Then I wait for the information about the underpricing to come out. The market will correct it eventually. It may take a month, it may take 6 months, it may take a year. Eventually, the stock price goes to where it needs to be. I make my money and I'm all good. So now suppose that the opposite situation arises, which says, I think that the stock price is way too high. The firm is overvalued. And now, what do I do now? I mean, if I already own the stock, of course, what I could do is just sell it because I think now the price is high. But what if I want to bet on the price being too high and I don't actually own the stock? How do I do that? And you can say, well, then you just can't do it. Well, that's not true. You can actually do something. One of them is, of course, through options, which we will talk about later in the course. We can use option strategies to do it. But let's just say that you don't want to do it through options. Can you still do it? Yes, you can do it through shorting the stock. So how does that work? Well, the first thing I need to do to short a stock is to find somebody who owns the stock that I can borrow the stock from. So suppose that Adam currently owns the stock. I go to Adam and I say to Adam, listen, can I just borrow the stock from you for the next 3 weeks? And then I'm going to pay you some money to compensate you for the inconvenience. But Adam was planning to hold that stock for the next 3 weeks anyway. So as long as I give him back exactly the same stock in 3 weeks from now, he's fine. He just has the same stock that he has in 3 weeks that he has now. He was planning to hold on to it anyway. It makes no difference for him. So what do I do once I've borrowed the stock from Adam? I immediately go to the market and I sell it. Now you say, wait a minute, can you do that? You just borrowed something from Adam and you immediately sell it. Well, I'm not too worried about it because I know that in 3 weeks from now, I can simply go back to the market in the liquid stock market. That's pretty easy. I just buy back the stock and I can give him back a stock of the company. So of course, what I'm hoping for is that I borrowed the stock from Adam. I immediately sold it on the market. I'm going to just sit and wait for 3 weeks. And I really hope that over the next 3 weeks, the stock price is going to plummet. If the stock price plummets, then the price at which I buy back the stock 3 weeks later is a lot lower than it was before. I get the piece of paper that is the stock. I deliver my promise to Adam. I give him back the stock. And I made money because I sold it in the beginning for the high price. In the 3-week period, the stock price plummeted, and therefore I was able to buy it back on a lower price, and I can simply pocket the difference. That's what we call shorting a stock. Now, the question is, of course, how worried is Adam about all of this, right? So is he going to lend me the stock if he thinks that I have private information? Suppose that he is worried that I know something about the stock that he doesn't. If that's the case, then of course he's not going to lend the stock to me, because what's the optimal thing for him to do then is to sell the stock himself right now. But if he just thinks that, you know, oh fine, if you want to bet on it, I mean, he doesn't really believe that I have any more information than anybody else, then it may very well happen that the stock actually goes up. It doesn't go down. I want to take that bet, but he doesn't think that bet is particularly informed, and therefore he has no problem lending that stock to me. I can try to do my bet. I hope that the stock will go down. If the stock will go up, of course, I have to buy it at a higher price than I sold it for, and I will simply lose money relative to the initial price. So this is how shorting works. The fee that you need to pay to the person who is lending you the stock is called the stock lending fee, and it varies quite a bit between stocks. It's another indication of how liquid the stock really is. Now you can think to yourself, well, is it easy to find people that are willing to lend you these stocks? And why would it be easy or hard? Well, one very natural party to go to borrow these stocks from is, of course, index funds. Because index funds, what is their strategy? They replicate the index, and they are supposed to just hold on to these stocks for as long as these stocks are into the index. So therefore, they were not planning to sell or buy those stocks anyway. It's not, and they don't really care about information or anything else, because their mandate is to replicate the index. So index funds actually, by being so active in the securities lending market, can boost their return even a little bit. They can earn a higher return than the index. How? By pocketing all these stock lending fees. So they get a little bit of extra money every time they lend out these fees. By definition, even if the stock plummets, it's part of the index anyway that they were supposed to replicate. And so they're not doing anything wrong. It's just in the index anyway. And in this way, index fund investors are very natural places to go and borrow stocks.
Great. Thanks, Jules. Next question relates to, Jules, can you address some more details, the various dynamics that exist between buy-side research analysts, investment advisories, investment committees, and portfolio managers? That's a broad question. So maybe start with that, then there's a second part as well.
Maybe this is more of a question that, shall I type? If they can be a little more specific, I can just type an answer to that and post that. Maybe that's easier.
In the forum, you're saying?
Yes, in the forum. I'll just...
you can email it to me and I can post it, absolutely.
That's totally fine.
That's a great idea. Sure, thanks. And then he just had a follow-up.
There was one question that I received, which I think is an important one. There was one question I received that asked the question of, what is my take on the active versus the passive debate, right? Mm-hmm. So what we're seeing now in the market is this question of, well, should you invest your money with active funds or should you invest it with passive funds? What's the difference between the two? Is the active industry too large? Is it too small? We talked about that already a little bit. So let's first go back to what the difference is. Passive funds simply invest in baskets of fixed rule-based stocks that are like an index. If you need to replicate the S&P 500 index, you're not pretending to have any information. You're not saying, hey, I think GE is undervalued, so I'm putting a little bit more of my money in GE, or I think GM is overvalued and therefore I'm underweighting GM in my portfolio. No, you're not doing any of that. You're simply saying, my job is to replicate the S&P 500 index, so I do it. I don't pretend to have any more knowledge. And so I'm also not charging my investors for having that knowledge, because you're already giving away that you don't have that knowledge. And then you just try to get as close to the return of the actual index that you can. That's what we call a passive strategy. Mm-hmm. An active strategy is exactly the opposite. It says, I want to beat the passive strategy. I think I can collect information on which stocks are over and undervalued. I take positions to try to exploit that level of under and overvaluedness, and I try to get a higher return. Now, as you will see soon, in competitive markets where all investors are going to try to go after these different strategies, because everybody wants to get an extra return, right? We can all agree that if you would know you could earn a 1% extra by going to one place versus another place, you'd be inclined to move your money to the place that gives you the higher return. So as long as markets are sufficiently competitive and people move their money around in that way, what we would expect to happen is that on a risk-adjusted basis, active and passive management give the same performance to investors. But now you may say, hey, wait a minute, wasn't the point of active that they would outperform? And so if they deliver the same return, how is that supposed to happen? Well, so what happens is this. The active manager charges a higher fee than the passive one. And so he still has to do better than the passive one to earn back his fees, to make sure that active and passive perform equally well. Now, suppose that you find that one of them underperforms the other. What do we learn from that? Well, you may think that that tells you something about managers, but as we will see soon, it actually tells you much more about investors. If it's the case that active structurally outperforms passive, it just means that not enough money has gone to active. Because if markets are competitive, everybody wants to get that extra return. They give a lot of extra money to active management. Active management grows by a lot. We've seen that happen, by the way, over the last decades. And that will eventually drive down the return, because active managers can come up with good ideas to invest in, but eventually they run out. And so we get, because of decreasing returns to scale, the return of active, as the active industry becomes bigger and bigger, we expect it to be depressed. Until, at what point are investors going to stop giving extra money to active? When it's equalized with passive. Now, what if we see active underperforming passive? Well, then that just tells you that investors are not taking out their money out of active fast enough. As soon as we see that active starts underperforming, the rational response is take your money out of active and start putting it into passive. Now, to conclude this discussion, to tell you the truth, the last decade or so has made active versus passive more of a gray area. I just defined it to you in very sharp terms, in which I said, this is what an active manager does. This is what a passive manager does. But what if I tell you that a passive fund says, oh, our passive, between quotation marks, strategy is to invest in value stocks. And value stocks are defined as stocks that have a particular, what's called book to market ratio, particular financial ratio characteristic. And the reason why we invest in value stocks in a rule-based way is because we think value stocks are undervalued and therefore they will get a higher return going forward. Then it's sort of in the middle between active and passive, because it is rules-based. You very clearly communicate what your strategy is. But it's also very clear that the purpose of the strategy is to achieve a higher return. You're not just replicating an index and trying to get exactly that index return like the S&P 500 or the aggregate stock market. No, you're picking a set of stocks that you think that will outperform. And so therefore, what we've seen is that the lines between active and passive have really blurred. And so when we say that passive has grown a lot, I do think it's important to take out the component that is the gray area before we can really see how much of the passive growth is really due to people saying, I'm just investing in the S&P 500, versus all these other so-called passive strategies that really have an active flavor to them anyway, because they're designed to give you a little bit of an extra return.
Mm-hmm. It's very interesting, Jules. And I think that the point, you mentioned with respect to the efficiency of the markets and capital following the good managers is something we're going to talk a lot about in this course, and it's really going to be an important takeaway, and also something I would just mention that Jules is actually really one of the leaders he's modest, but he's one of the leaders in the field for his research in this area. So we're excited to dig deeper in this concept, Jules.
Thank you. I think that this, what I just said, I think George posted a question. that related to this. And so I can give a more detailed answer, but I think part of it has already been answered, I think. But I'll post a more detailed answer to George's question there too.
Well, that'd be great. That'd be great. We had two follow-ups on shorting, which I'll combine into one question. The first is, are mutual funds allowed to short stocks or just hedge funds? And the second is, from a mechanical perspective, what happens if the stock goes to zero? Do you still need to refund it, to return it?
Okay, so the first one, generally, we're saying the idea of mutual funds is that they wouldn't short. However, there has been the development of the so-called 3130, which is still called a mutual fund, which is allowed to go 130% long in a particular stock and go 30% short in other stocks, right? So yes, they're allowed to short, but you can already see in the amount of money that you allocate to the shorting versus the long, it's not like you can really short a lot. You can just have a 30% portfolio weight and we'll talk about portfolio weights much more in detail in the coming weeks. So this comment that I'm now giving will become much clearer as we go through those portfolio weights. But the sort of the intuitive notion is, yes, they're allowed to short, but only a little bit, not too much. And that's what the 3130 is. And so I think you will hear a lot of people say that effectively mutual funds don't really short. Right, but officially the answer needs to be there is a particular type of mutual fund that can do the 3130 strategy and therefore can short a little bit, but it's nothing compared to the amount of leverage that a hedge fund can take. So that's that. In terms of the stock price going to zero, right? It is actually quite rare for a stock to exactly go to zero, right? So even when firms have issues and they get into financial trouble and they eventually need to delist, then it's still not actually a price of exactly zero, right? There is what's called a delisting return, which is the last return that as an investor you earn. But it depends a little bit on what happens to the company after it goes bankrupt and who exactly gets what. Right? Now, if it, in the rare case that it would happen that the price is exactly zero, I think it depends on the particular exchange or the rules that are set, what needs to happen in that case. Because there's another thing that I think is important, which is that stocks are not only used for financial investments, right? There's another aspect to them, which, by the way, if the stock price really goes to zero, actually also becomes irrelevant, but it's debatable, which is that equity holders have voting rights. So if you own a stock, it's not just that you make financial return. If you own a stock, you're allowed to vote at the shareholders meeting about decisions that the company makes. Now, of course, if the company really is bankrupt and therefore the stock price really goes to zero, the whole point is that the current equity holders no longer have a say because the debt holders essentially take ownership of the company and therefore they start running the company. They become the new equity holders. So it depends a little bit on what the rules are there, until what point exactly the shareholders still have voting rights, when exactly that transition of ownership would happen, and how all that process is dealt with legally, which undoubtedly differs between different legal environments.
Mm-hmm. And what is your thought on that, Jules? I mean, in terms of the rationale for why mutual funds would be unable to short. I mean, it seems like if you're a pension fund and you're giving your money to a manager, and the manager has research and that indicates that stock price is overvalued, that we should be able to benefit from that. So I guess structurally, do you think it's sort of silly that mutual funds are unable to short, or what do you think would be appropriate from a policy perspective?
Well, I think it very much fits into that discussion that we had earlier about how much regulation do we have in these two different segments of the market, and why do we have that regulation? And as you already saw also from the questions that we had, shorting is generally a quite complicated topic. And therefore, I think the expectation is that a regular retail investor has a hard time fully understanding what shorting means and what the risks are that are involved with such strategies. And so the whole point of mutual funds and the access of retail investors to mutual funds is that you don't have to be a sophisticated investor or a qualified investor to be able to invest in mutual funds. And the reason why we want to have that way is therefore also that we don't want mutual funds to engage in strategies that only a qualified investor could fully understand. And so you see how the type of clientele that mutual funds serve intersects with the level of sophistication that is involved with shorting. But you also see that it is shifting, because why otherwise would we have the 31-30? Once you're willing to go for a little bit of shorting, I mean, but you can really see that, we want to let them do it if they really want to do it. But then on the other hand, we don't want them to take such extreme positions that it leads to risks that investors could get very nervous about and retail investors wouldn't understand. And so I think that's a nice example of sort of the trade-off there.
That's interesting. So you're saying it's not even necessarily that these things are inherently more risky from the individual perspective. It's also largely influenced by sort of the perceived complexity that creates the confusion. So it's almost more the perception of risk than perhaps actual risk itself.
Yeah, although of course, if you really don't understand something, it's very hard for you to
right.
This, right?
Yeah, it's true.
If you don't understand it and somebody tells you it's not very risky, then still, if somebody tells you that bungee jumping is totally fine because it isn't very risky, but you don't understand it very well, you may still really bother not engaging in the activity.
Right.
And so I think that makes that a little harder. It's, by the way, also the reason why derivatives are something that mutual funds use very little, because derivatives, and we will have a little video on derivatives as well, and explaining what they do and how to compute their price and so forth. They're also much more complex than just investing in plain vanilla stock.
Absolutely. Great. All right. Another one, going back to smart beta, question is, are smart beta funds or factor-based index trackers, would you consider those active or passive? Yeah.
So that's a wonderful question. And I think they're exactly the example of where the breakdown is very tough, right? I mean, the whole original idea behind passive and index investing came from the whole sort of Markowitz-Sharpe revolution in finance, where we said, just spreading your money across the entire stock market according to the weights that their valuation is. So you don't have to think about it yourself. Just hold the widely diversified portfolio, spread your money across all the available stocks exactly in proportion to their valuation in the market. That whole idea, once we go to these more like, hey, can we get an extra return here and there by just being smart about it? And then, of course, there are people that argue, yeah, but that's just because those are also risk factors. Some people just think they're investment opportunities. Some people think they're risk factors. We're actually going to have a video that's going to talk about the importance of asset pricing models that exactly asks the question, are these factors, should we think of them as risk? Should we think of them as investment opportunities? What is an average investor? How would they look at it? And actually, I think we're going to show quite a bit of evidence that regular investors see them more as investment opportunities rather than risk factors. But that's still coming up. But that's a wonderful question, though. I really like that question.
Great. George has also pointed out an interesting point relative to mutual funds and shorting, which is that there are a lot of available short or ultra short ETFs that any individual investor can buy. So to some extent, how do you reconcile that, right?
No, agreed. Yeah. And it just shows you that, you can regulate as much as you want, but as soon as people feel that there are opportunities, market solutions around regulation will be found. Right? And that is also why, as a regulator, I think that's a more general point regarding regulation. As a regulator, you're always behind. Right? So you try to regulate something, then the market responds to it by finding a way around to regulation. And then you need to come up with a new regulation that addresses that particular case of the way around it. which then just is the incentive for the market to come up with yet another reason to get around the regulation or a different way. And so in that way, it's this back and forth the whole time between regulation and market solutions, where the regulator is always behind relative to the market. And then that's unfortunately just part of the deal that we're in.
Yeah. It's interesting. Yeah, Peter's pointing out, giving a so warning to folks on some of these ultra negative ETFs that they're not necessarily what you think are. Yeah.
So Peter's point is very well taken. We see a very large growth in ETFs, but for ETFs, it is very important to read the fine print. That doesn't only hold for the ones that do the shorting. That holds in general for ETFs. I mean, there are different provisions for dividends, there are different provisions for many different things. So before you invest in an ETF, make sure that you actually very carefully read what's going on. You can also already see, therefore, because of these things and how the market deals with them now and what the fast growth of them is, that is just a matter of time before we'll have more regulation on ETFs, right? Mm-hmm. You see it coming. I mean, we've seen such an excessive growth of them with so many different fine prints that are involved. We will soon have more standardization of them, more clear reporting of them is my prediction, at least.
Yeah. Okay, on that point, I wanted to get Stephen his first question about ETFs, actually. Let's see if I understand this. His question is, do you think ETFs using derivatives replication methodology or swap versus full replication methodology is more efficient? Or I guess, yeah. Do you have any thoughts on that?
No, I think we will soon see research on this that tries to explore that question. Whether or not, I think the jury's still out on that. I think much more. I mean, there's still a relatively new phenomenon, and so we're seeing a lot of different things being tried. And so I think that future research will have to show. And I, as I said, I mean, in the beginning, when you have these new things, you see this, by the way, now too with all the cryptocurrencies and all these other things. As soon as these new things get introduced, the first reaction that you see is a huge growth in all kinds of directions of them. And everybody's trying all kinds of new things. We saw it with the tech bubble as well. And then eventually we'll see some sort of convergence towards, the things that work and the things that don't work, the things that are solid and the things that are not, the things that are more efficient where we get efficiency gains and where we don't. Mm-hmm. And so I think the time will tell whether that's true or not.
Yep. All right, we'll try to sneak in a couple more here and then let you go. Jen just had a technical question. I think I know the answer, just maybe could clarify is when the stock does go to zero or almost zero, is that what you consider default or what's the technical definition of default relative to situations like that?
Well, so I would say that if a company defaults optimally, meaning it declares bankruptcy or its debt holders request for bankruptcy, that usually implies that the value of the company is worth less than what the debt holders have been owed, meaning that the equity has essentially become worthless, right? So the debt obligations that you have, think of a house, okay? So you put in, the house is $500,000. You put $100,000 down. That was your equity. You owe $400,000. When would you default on your mortgage and potentially walk away from the house? Suppose there's no recourse, so you can just hand in your keys and you can walk away. Well, when the house price drops below $400,000, then your equity is gone. Your $100,000 is worthless. And so the level of debt that you owe the bank is worth more than the value of the house, in which case you hand over the house to the debt holders and you walk away, right? So generally default in many cases implies that the stock is worth close to zero, right? Now, is the other way around always true as well, right? I mean, so the question is, do you declare default necessarily when the stock price is very close to zero as well? That depends, right? I mean, there are many stocks that are traded that are penny stocks, which essentially have a stock price that is close to zero, and yet they're still being traded.
Mm-hmm. Great. And then thanks, Jules. And then Peter just had a follow-up relative to the swap-based ETF discussion that while the jury's out, essentially is implying that there was a stress test with the financial crisis where they fared, relatively well, which is an interesting point, I think. Yeah, observation. Yeah, good. Well, Jules, I think that's a wrap for us. It went by pretty fast.
Yeah, it was wonderful. I'm sorry we didn't get to speak in person, which it was just through the chat box and through Adam, which was great. But I wish I would be able to meet you personally as well. But
yeah, well, we're gonna try to do an event if we can schedule it on campus at some point later in the year, which I know not everyone can make it, but it'd be fun to do it. It's always fun to meet up, in person, and we'll see what we can do. But thanks everyone for joining. We had a great group today. We've got a great group in this first session. People from 20 different countries. Keep contributing your thoughts on the forum. So let us know how we can help, or if you have ideas or questions. The TAs are here to help. Now that you've seen this first session, you can get a sense for what to expect next time. Our next session will be Tuesday, 10 a.m. New York time. And you'll be able to ask if there's any follow-up questions from week 1 material or week 2 material as we dive into things. So that's it for today. Thanks everyone, and we'll see you next time. Take care.
Thank you. Bye everybody.